Hello dear followers and welcome to our new episode which will guide you through the 5 things each investor shall do. There should be growth and value, strategy and psychology, all at the right timing. Simple, isn't it? Give this video a thumbs up, subscribe to the channel and let's go. Number 1. Seek for sustainable growth. As when you are in the driver's seat, you shall look ahead and steer through your stock picks. As trivial as it might sound, it is very important to evaluate the future prospects of the stock you think to invest in. You can expect the stock price to grow if the company's earnings are forecasted to have a sustainable growth as well. The more money the company makes, the higher the price the investors are willing to pay for it, which in turn drives the price even higher. Fortunately, this information is publicly available and you can easily evaluate the trend of the earnings growth. Even if a company currently does not make any money, you can easily find out when it is forecasted to become profitable. Number 2. Know the value of what you get. Most of us have an intuitive feeling when question comes to how much is it reasonable to pay for an apple, a pair of shoes, or a TV. This is because we can evaluate the value behind these goods. The same principles apply to the stock market as well, as there is a so-called intrinsic value of the company. This gives an indication of what are you actually getting when you purchase that piece of the company in form of shares. Obviously, not all the companies are equal, and an investor needs to get that feeling of what is worth paying for a certain share. Although, to evaluate that magic value is not an easy task and there is no universal formula to apply, a simple and basic concept is to compare what you pay for a share to how much money the company earns per that share. This is known as price to earnings ratio, and it is also publicly available. By comparing the PE ratio of a company with a sector average, you can get a picture of how efficiently it is priced. Quite similar as when you research the Apple prices on the market and then judge what fits best for your needs. Number 3. Understand market psychology. All the investors are interesting human species. They are influenced by emotions and instincts such as fear, greed, gambling appetite, but also by enthusiasm, hope, and faith. That actually means they are normal people. Believe it or not, that translates into an overall market sentiment. Understanding the market psychology and cycles it rolls can considerably improve the investing performance. One should not have been a genius to anticipate that the pandemic outbreak in 2020 will drive a massive sell-off, as the investors started to fear over the stability of the global economy and politics. Maybe it was not that trivial to anticipate a so fast recovery, but since the end of the world did not come and the governments were pumping trillions of dollars into the economy, the rebound definitely was anticipatable. Understanding of the sentiment applies to individual stocks as well. A best-in-class example is Tesla. Everyone wants a greener future, and Tesla made itself a symbol for the electric mobility. This turns into enthusiasm and collective faith, which drive the stock price to new heights. An ability to identify such opportunities is extremely useful. By the way, did you know that Tesla had a negative net income until 2020? Now you know. Number 4. Build the strategy. No perfect strategy exists, especially if you try to focus on a particular tactics or principle. Investing exclusively in growth stocks is very risky, but investing only in value stocks and waiting years to grab the fruits does not look bright either. Relying only on technical analysis might easily draw you into a rolling snowball of losses if the company had a dramatic change in its fundamentals and you missed that. Even investing in the all-good S&P 500 is boring and unattractive. The best thing which an investor can do is to diversify. A cocktail of growth and value mixed with broad market indexes served on a chart of technical analysis, this is my favorite daily drink. Whenever you agree or not, my last word on that is that you should have some strategy. Develop it and stick to that. You will see it is not perfect and you will work to optimize it, which is totally fine. The worst strategy of all is to have no strategy. Number 5. Trade when necessary. In other words, avoid overtraining and avoid trading just because you cannot sit and look doing nothing. Sometimes it is better to wait. I am not encouraging you to time the market, which is almost impossible to do. What I am saying is you should develop a discipline and get armed with patience. Don't do investing mistakes because you cannot resist the temptation and fall victim to herd madness. Rather, do mistakes on your own because of your own wrong judgments. This will make you a better investor over time and you will learn to take better decisions. That being said, I leave the rest on you. Don't hesitate to invest. It is fun, entertaining, and profitable. Green days to all of you.